PPA, Purchase Price Allocation, Accounting section of CFO100. In this lecture, you learn PPA, Purchase Price Allocation. It seems to be a minor topic of accounting study, but when you invest in a company, you are always faced with this topic. So, this is a very usual topic from an investment perspective. As CFO, you need to understand the concept and regard it as a hot topic. Then, you can pay attention to it and properly handle it to control your company's PL and BS. This topic occurs in the case that a company acquires the other existing company. You can see a simple sample here. Company A acquires Company B. Company A paid $100 million to buy the share of Company B. The amount of equity value in the book of Company B is $70 million. There are 30 million differences between those two numbers. PPA indicates how you should recognize this difference. When it comes to that, you think about this concept. The key point is that you consider why Company A buys Company B's share with an extra amount. This is the starting point of PPA. Why should be careful about this topic? This is because the treatment affects your PL and BS not 1 year, but entire long years. If CFO correctly understand the concept and keen about the treatment, you control significant part of impact from investment activity. To get into detail of PPA, you should learn more about the basic way of thinking. As I mentioned, PPA is coming from the difference between the invested amount and the book value of the asset. The most important point in this lecture is that there are two types of categories to regard this difference in investment. The first one is amortization assets. The second one is goodwill. Both of those two words sound very unclear. The easiest way is that you should ask ourselves why you pay the larger amount than book value to acquire this company. The answer to this question is that buyers recognize much value of this company. If so, the next question is that what kind of asset have such excess value this company has? To answer this question, you figure out that this company has the know-how, license, patent, and other existing intangible assets. Amortization asset can give the category for those reasons. On the contrary, if there are no specific assets, it is just an expectation for this company. We recognize it as goodwill. This allocation is done at the timing of investment. Precisely speaking, we have time to assess the categorization, but it is almost same timing of investment because you should think of how you will categorize this difference of investment when you consider the profitability of the investment. By doing so, you can include the PL and BS impact in your planning. Otherwise, you must recognize unexpected PL impact in future surprisingly. As one of important role as CFO, You need to control the risk of impairment. The treatment of PPA is directly related to this topic. You can learn the mechanics in next slides. In this page, you can learn more about the case when you need to take care of PPA, and you learn how practically manage this difference in investment as amortization asset. Also, you should understand what kind of situation this goodwill has impact on asset management perspective. Since this is one of the business assets, you recognize the amortization as these assets. Amortization means two things. One is PL impact as amortization cost. Second is BS impact that the size of this asset is becoming smaller year by year. Amortization depends on the length of the effect of the asset. This impact on PL and BS seem to be a negative impact of our business at first sight, but this cyclical impact is easily predicted and manageable. It is no surprising. Secondly, you must see the movement of goodwill. Uniquely, the size of goodwill will not be changed even after spending years. It continues standing on BS. This seems to be nice as it sounds. However, it has an adverse effect. If the book value of this investment is still large, it means a risk of impairment. To calculate impairment loss, we compare the size of fair value and book value. If the book value is still large size, impairment easily happens. It is not good from an asset management perspective, even though it has no cash impact. Once you categorize difference in investment as amortization or goodwill, you cannot change the categorization. If you misunderstand the allocation and mishandle the allocation, it remains risk in entire investment years. The large size of book value also has negative impact to divestment decision making. The capital gain and loss is calculated with the difference between book value and selling value as well. The large amount of book value means difficulty to realize the profit or capital gain in future in the divestment deal. In general, it is recommendable to understand the amortization assets as much as possible and reduce the book value to avoid sudden impairment loss. As CFO, you should give instruction to business division and accounting division to make them be aware of this issue and consider the topic in advance. Though you have learned the concept and basic direction to treat PPA, the small and working level of tips will be explained in another lecture.